Hi, everyone. This is Jason Biark of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He has over 30 years of experience in the oil and gas industry, including as senior management at Hess Oil, where he was there for 18 years. He is president of the Energy Prospectus Group, and they cover a lot of small and medium-sized independent U.S. oil and natural gas companies, something that my listeners have been asking about. So I thought I'd bring him back on and get his views on the oil and gas markets and also the companies that he covers. Dan Steffens, thank you for joining me again.
Yeah, sure. Nice to be back. It's been a while, a couple of years, it seems like.
Yeah, I mean, the oil and natural gas market started getting interesting again in February, March, April. I don't think I've ever seen anything like that happen before.
Oh, yeah. Good Friday, actually, the 10th, I marked that on my calendar is when the gloom and doom over COVID-19 reached an all-time peak. You know, we were all going to die. And at that point in time, everybody thought all these companies were going to go bankrupt. And since then, the ones I follow as a group, they're up over 50%. So if you'd have picked that date and you'd have jumped in with both feet, you'd be a happy camper right now. But the overall market's come back since then too. So.
And we're recording this interview on Thursday, July 16th. The WTI crude oil price is above $40 a barrel. It's been range bound for the last month or so at $40.75 a barrel. Brent crude's at $43.37. I want to get your views, though, on the changing picture for supply-demand fundamentals. So how much did demand fall during that period from February, March, April, May, and how much has it recovered since then?
Well, the projections were, just horrific that it was going to fall in April by 30 million barrels a day. And for your listeners, in 2019, the world consumed over 101 million barrels a day of refined products, oil-based refined products, which most of them, 90% of them, are made from crude oil. There's also some biofuels in there and some NGLs, natural gas liquids mixed in, but most of it is crude oil. And so, a 30% drop in demand is an historic event. I mean, that's never happened. I mean, and this is oil is a commodity that if you get a 1 or 2% move in, tightening or loosening of supply and demand has a drastic impact on price. So it wasn't surprising to see oil go from over $60 a barrel at the very beginning. The first week of January, we actually touched $65 a barrel shortly, and then it went all the way down to $10. And actually, the futures contract went negative for a couple of days, although that was a bunch of paper trades. In the real world, oil dipped to just above $10 a barrel and then rebounded pretty, sharply. And now we're back to 40. People are getting positive cash flow from operations now. The U.S. oil industry will eventually survive. It's going to be a tough, a second quarter results are going to be as bad as it gets. And then it should be improving from then on.
So do you think the worst news then is going to be priced in the second quarter? Because on the first quarter conference calls, a lot of the larger oil company executives were saying that the second quarter is probably going to be worse than the first quarter, and that's probably going to be it as far as bad news goes.
Yeah, it's going to be improvement after that. And you got to give it to them. The reaction of how quickly they cut back on spending was also extremely dramatic. I had several of these companies, they had come out, earlier in the year with these, we're going to run 10 or 12 rigs all year and all these completion crews, and we're going to jack up our production again. And then suddenly half of the companies I follow have dropped all their drilling rigs, and most of them have stopped completing wells. Even the guys that are still running drilling rigs because they're under long-term contracts, they're not completing the wells. So very few wells are being completed. And as a result, U.S. production dropped from 13 million barrels a day to 11 million barrels a day now. And we don't have nearly enough rigs drawn for oil to keep oil production from falling. At the current active rig rate, there's only about 185 active rigs drilling for crude oil. And we were up at about 800 drilling for oil just 6-8 months ago. And we were having trouble holding production flat then. So there's just no way with our increased depletion rate that we have now that U.S. production, if oil stayed at 40, you'd be pretty much on terminal decline.
Interesting. So the CEO for ConocoPhillips recently has said that if oil prices get back to about $45 a barrel, that I think for his company personally, but maybe industry-wide for in the Permian for U.S. shale oil producers, the lower cost ones, that they can bring back online maybe about 500,000 barrels per day of oil production pretty quickly. Do you think that's accurate, or do you think that a lot more production will come back online the higher that oil prices go? If it goes to 45 or 50, it's going to be incremental then?
Well, one thing, we do have oil coming back on that was shut in. You may remember that, there was fear that storage was going to fill, because think of that. About this. We had just this drop off in demand for products made from oil. So you had inventories of both refined products and crude oil like stacking up in the supply line. So there was fear that we would fill up Cushing oil tanks, and there would be no more storage. We're still very high, and the pipeline companies informed a bunch of the producers that they were going to have to shut in wells that couldn't take the production. So we shut in economic producing wells were shut in that were producing about 1.5 million barrels a day. So we went from 13 down to, actually we dipped all the way to 10.5 million the second week of June. And now that started to come back. So we're back to 11 million, but we also have, the rapid depletion of these wells. So as far as the price is concerned, yes, in the Permian Basin, tier 1 areas, the really good acreage, they've got the well drilling and completion down to some areas under $40. So, you can still have, wells will pay out at $40 or $45 a barrel. Now they're not, at $60 a barrel. These wells were paying out in less 2 years, so it might take 4 years for these wells to pay out. But still, a decent return on capital employed.
Who are some of the lower cost producers that you cover?
The EOG is probably the best. EOG Resources. I like Concho Resources, which is still the stock is trading about where it was back on June 10th. It hadn't gone up with the rest of the pack, and they've got a bunch of their production hedged. They really got a lot of good hedges in place, so they're not being hurt that much by this dip. They're a good low-cost producer. Cimarex. Now, Cimarex has a lot of gas production. They're good. Parsley. Parsley is a pure play. Their symbol is PE. They're a pure play on the Permian Basin. You guys might look at that.
So their costs, you said they're low-cost producers. Are they producing oil at $30 a barrel, $35 a barrel? How much margin do they have right now? So they're all these companies you mentioned are generating free cash flow at current prices?
Well, they're generating now. Free cash flow is net of CapEx spending. So think about it this way. If they're selling their oil for $40, their lifting cost, including production taxes, transportation, gathering, and everything, for most of these companies is only like $15 a barrel. So they're generating positive cash flow. Now, that's going to take a long time to pay out the, $8 or $9 million that it costs to drill that well. So, but just looking on cash flow today from a producing well, they're generating some solid cash flow, a lot of these companies.
Yeah, I was looking at EOG Resources last year before the oil price crashed, and I was looking through the investors' presentations. The management team was cutting back on a lot of debt on the balance sheet. They were paying it off, so they came into the oil price crashing in really good shape.
Yep. I just made a slide for what I'm going to talk about this Saturday, and EOG's break even for drilling new wells actually is $35 a barrel.
Yeah, I think they're probably the most efficiently run of the larger mid-tier oil companies in the United States.
Yeah. Also on the low end of this price chart that I'm looking at, Parsley is actually the lowest. Now they're a much smaller company than EOG, so maybe your guys haven't heard of them. But NBL, which is Noble, now they're got a lot of gas production, and then Cimarex, Pioneer, and Concho and Diamondback are all down there with the lowest break-even costs on a lot of their wells.
So you put out a very interesting podcast on Saturday, and your YouTube channel is underfollowed. There's a lot of good oil information there, so my listeners should definitely check it out. There's a lot of good free information there that you should put, a lot of other people would put behind the paywall that you give away for free. And in there, in the presentation, you're talking about the second half of 2021, that the oil industry needs $60 a barrel oil. So is that going to be a combination of supply and demand fundamentals, or is that just for replacing the oil that's produced right now?
Well, I don't think the shale industry can keep growing production at anything less than 60. I don't think you get a justified return on your risk of capital unless you're in the 60s. So that's why I say 65, in my opinion, is the right price. And remember, we were headed there. The first week of January, WTI touched 65 and actually averaged probably in December and through the first week or two of January, we averaged more than $60 a barrel. So that's where we would be if we wouldn't have had this pandemic. And U.S. production actually peaked in November of last year and was going on decline. It always goes on decline a little bit in the winter just because of weather-related shut-ins in the winter. We always have kind of a dip in production the first half of the year. And then, when the weather improves in the spring and summer and we can get after it a little bit more, it picks up. But I think we need $60, $70 oil, and I think we're going to be headed back there because really when you look at where did the global economy get their oil the last 3 to 5 years, it's pretty much most of the growth has been come from the United States. And the magic of horizontal drilling and fracking and everything on these long horizontal wells has led to all this new production that we've been able to develop rapidly.
Yeah, I completely agree, because if you look at the CapEx budgets or capital expenditure, for our listeners who don't know what that means, a lot of these other oil companies, the larger integrateds, the national oil companies, they've been cutting back on their CapEx for a long time. And the major CapEx growth drivers, besides some deep water in Western Africa, has been the U.S. shale oil producers.
Right. They're under tremendous pressure from Wall Street to live within cash flow and start returning some of this money to their investors. See, really what happened in the oil and gas industry was there was this tremendous land grab. For one thing, when you're drilling these 2-mile-long horizontal wells, they're going down over a mile, and then they're drilling sideways for two miles. And they need a lot of acreage. So you need 2 sections. That's 1,280 acres just to drill, 4 wells one way and 4 wells the other way. So they had to get large acreage blocks. Well, the acreage got very expensive, and they had these big sunk costs. Well, then they had to go out and drill it rapidly because all their leases were 3 to 5 year leases. So to hold that acreage, they had to go drill a bunch of wells. So there was a ton of capital. And this is typically what happens in all new oil fields, always have a lot of upfront CapEx. And then you start getting a lot of production, and then they become self-funding for continued growth. So we were getting to that point. If you go back to when oil was in the $100 range for about 4 or 5 years there, and then it dropped out, we were already getting to the point where we were getting completed well costs down, and we were getting much better wells because they had figured out how to complete the wells better with targeted fracs, and Halliburton and Schlumberger came up with outstanding ways to log these wells so you could get your horizontal portion of your well in exactly the right place in the formation. And because of that, we were getting much, much better wells and better economics on these wells. And so well cost, break-even costs were coming down. And now, today, a $60 oil price would be equivalent to a $100 oil price on profitability if we could get back to that, if we can keep these well costs down. Now, the upstream companies have beat down the drilling costs so much that they're going to have to give some money back to the drillers, because the drillers got to make money too, and half of them are going to go out of business because they can't make money at these beaten down rig rates.
So do you think then at $65 or $70 a barrel, I would call in that range, like $65 to $85 a barrel, I would call that the Goldilocks oil price, where the oil producers, the lower cost ones, can make a good margin, make some free cash flow, maybe pay dividends, and then the consumer is not getting killed at the gasoline pump? Right.
Actually, Raymond James's ideal price is 65 to 70. That's what they say the long-term price should be in today's dollars. Now you have inflation on top of that. So, 5 years from now, that might be $85, $90. I don't know, because I think we're going to get some inflation here pretty soon. And, but anyway, yeah, you're right. That a good definition is the Goldilocks. It's where, it's fair. I mean, for any commodity, think about it, a commodity as important as oil and gas is to our standard of living. you have to give these guys to take the risk. You got to give them some profit on their investment, and for the tremendous amount of money that has to be spent on these things.
Yeah, if oil gets too high in price, gasoline gets too high in price, jet fuel gets too high in price, there's problems for the consumer. And if oil price and gasoline and jet fuel price gets too low, then there's problems for the producer. So that's why I said the Goldilocks. Yeah. I thought about this a couple of years ago. I made a short little video explaining this. It's in the archives of my YouTube channel.
Right. It's just amazing. I had a discussion with Jim Poplava. He has a radio show on the West Coast. And he said, it's so unique with oil. Here's a commodity that's almost as important as food to humans. And yet we can't get a stabilized price. And it's just, if you have 1% where 1 or 2% demand exceeds supply, you have this big spike in price, and 1 or 2%, more production than demand, and you have a big drop in the oil price. It's amazing how we've let the traders take control of this oil price the way it has.
Yeah, it's the paper futures contract. There's a lot more paper oil futures contracts. Yeah. I heard from hedge fund contacts that specialize in China that the Bank of China, I think they were on the wrong side of that trade on the derivatives, and they couldn't cover. So I heard the Bank of China lost $100 billion in under a week, and that's one of the main reasons why the oil price went negative, besides the trading software like Interactive Brokers blowing up.
Yeah, for your listeners, be very careful if you buy commodity futures, because if you own a NYMEX crude oil futures contract, on the day that contract ends, matures, you have to take physical delivery of 1,000 barrels of oil. And that's what happened. There was 2 or 3 hedge funds, big hedge funds, that were they had too many long contracts, and they couldn't find any refiners. The people that bail them out are usually the refiners will bail them out at the end and take the oil. There wasn't enough people willing to take the physical delivery of oil, and they were stuck with those contracts, and they could not close those positions. And therefore, they ended up paying somebody $40, $50 a barrel to take those contracts off their hand. No one would ever believe that could possibly happen, and we've lived through it. It's something we can tell our grandchildren, I guess, because it was an epic day or two there when oil went negative.
Yeah, I think Carl Icahn said publicly that he thought he would never see anything like that in his life, and he made, I think, tens of millions of dollars in only a day or two because he...
Oh, yeah. Think about the people that shorted it. If they were short oil on that day, oh my God, they made a fortune on those short contracts. So a lot of money changed hands on that week, that's for sure. I think that was it was the May contract, so it was the last week of April when that happened.
Yeah, the USO is such a mess. I've been warning people now to stay away from them for months, but they have changed things a little bit, but I'm still very skeptical about their whole structure. I mean, what they should be doing is just storing physical oil, build storage facilities, store the physical oil, buy it when it's cheap, and then when it's expensive, goes up a lot in price, and sell it. But they're playing in the futures game, and they're telegraphing their moves with the front month futures contract.
Yeah. And I think they've changed their rules that they cannot hold those contracts to the last week anymore. They have to close their positions a lot earlier. So that should be behind us. And let's hope that's behind us now. But I think oil is going to flop around here in the 40s until we get some direction on, travel restrictions related to COVID-19. Personally, I just don't think we cannot have rolling shutdowns of the economy. It's just not going to work.
Now, if oil does get back to $65, $70 a barrel, are some of the companies that you cover in the Sweet 16, are they going to have dividend increases?
Yeah, they do. Some of them are still paying some dividends now. I think EOG has a small dividend. I think Concho started a little dividend. Diamondback, FANG, as their symbol, FANG, has a little dividend. But for dividends, if your listeners are looking at dividend, there's a lot of great dividend companies in the midstream. These are the guys that have the gathering systems, pipelines, storage facilities, here with all this oil and refined products filled up in storage, the people that own the storage tanks, they're doing quite well, and they're paying some double-digit dividends, some of these companies. So,
and they have record amounts of oil and natural gas in storage, so they just get to charge fees on that?
Yeah, they also, though, they have a lot of pipelines, too. And, they get paid there for throughput. So if supply and demand are down and throughput is down, that's hurting them on that side of it. But they also get money off their storage facilities.
So you mentioned the oil refiners taking the oil off of people in trouble in the futures contracts markets. One thing you talked about on your Saturday podcast was that the amount of oil that the oil refiners are actually using for their capacity is down a lot. So can you talk about what's the normal levels, where we're down at, and how that affects maybe oil supply demand?
Yeah. Now, seasonally, we are in the peak demand period. Let me get one of my slides up here.
Yeah, summer driving season normally, right?
Yeah, this is summer driving season, and usually at this time of year, our refiners are running at about over 90% capacity, and many years we've been over 95% capacity in June, July, and August as they have to ramp up for summer blend gasoline. And one thing about summer blend gasoline, it requires more crude oil. Winter blend gasolines can have more NGLs, natural gas liquids, particularly butane can be blended in. And the problem with that, though, it makes it evaporate faster. So in the summer, they don't let them do that, and they have to use more crude oil. So we're currently refining utilization in the first week of June dropped down to almost 70%, which is super low for June. I mean, by June, we're always 85, 90%. And by July 10th, which is this last week they reported, we'd be like 92 to 95%. And last week, EIA reported that refinery utilization was 78.1%. It's been ramping up slowly, about 1 or 2% every week. And I think by the end of August, we should be hopefully in the 85, 90%. And we don't burn crude oils in our car. We burn refined products, and the users of crude oil are the refiners. And we have the largest, most sophisticated refining capacity in the world. And so we're the number one consumer of crude oil here.
Do you think that there's going to be some buyout opportunities for larger companies like Chevron or ConocoPhillips to go in there and maybe make a hostile takeover offer for, I don't know, discounted for Occidental Petroleum or EOG Resources or one of the other companies you already mentioned in the Sweet 16?
Yeah, I don't think Oxy's going to be making another deal. They got crushed by their deal of Anadarko. Yeah, but they may be a target. Sure.
Well, that's what I was. Yeah, that's what I was. Sorry, that's what I. Yeah, I was asking because, Chevron was in a bidding war with them in October and they lost that bidding war. That was a blessing in disguise. But now Chevron may have the opportunity to buy the two companies, Occidental and Anadarko, for maybe the price of one.
Yeah. They have to do something about their debt, though, because they have to somehow assume that debt. There's some real high quality reserves. We mentioned one earlier, EOG. EOG's production is 600,000 barrels a day. I mean, that's a big ticket for even a ConocoPhillips or Exxon even. I mean, to add 500,000 barrels a day of production. And what some of these companies are trading at their 52-week lows. So, there's a lot of oil reserves that are available on Wall Street if you have a long-term view that oil is going to bounce back to $60, $70 a barrel in a year or two. Now's the time to really go out and do some shopping. I told a guy the other day with a hedge fund, he called me and he said, well, what are these little guys, you want to go after? And I said, well, you got to look at their debt because you're assuming their debt too. But, if you had $1 billion and you want to, you could get up to 100,000 barrel a day company by rolling up 3 or 4 of these littler ones and, rolling them together, getting rid of the cost of several of them being public, and you'd have a nice company.
Yeah, I think Chevron would be smart to be on the prowl looking for some acquisitions here at this point, especially if there's another correction in the oil price. There's kind of some rumors that Texas may shut down. I don't know if you are in Texas, but there's like rumors going around that Texas may be on a forced government lockdown by the governor. So if there is a drop in oil price, I could see companies like Chevron wanting to go and buy up, make some acquisitions.
Yeah, let's hope it doesn't come to that. I think it's extremely foolish that we're keeping our schools closed since the disease is not really, deadly for children. I don't think we have not had a single confirmed death under the age of 20 in the state of Texas, and yet we've got all of our schools closed now, which is kind of crazy. I think it's because the teachers union doesn't want to go back to work, but I know the fear level is unbelievable for this stuff. I mean, in my opinion, we live in a fallen world. We have to deal with diseases, and life goes on. So, let's hope we don't. I just don't think we can afford having these rolling shutdowns, one right after the other. I don't know how anybody with a restaurant or a bar or a health club or anything, how they can possibly stay in business. So,
yeah, I agree. I agree. Yeah. People should take personal responsibility, and there's a bunch of safety precautions that a business owner and individuals can take.
Yeah, I mean, people just got to keep their distance, wear masks if they need to go work out or something. And I work out every other day at a health club up the street here, and you know, people are behaving. They're not going around getting each other's face, and that's the right thing to do.
So switching gears, I want to ask you about natural gas. In the presentation on Saturday, you said the natural gas industry has to have $2 in the not too distant future. But here we are on Thursday, June 25th, natural gas got as low as 1.546. It rallied up to 1.876 on Tuesday, July 7th, and it's been correcting, and it looks like it could be headed back down. It's at 1.726 today. So are there any low-cost natural gas producers you cover that have clean balance sheets? Maybe they're hedged at a higher natural gas price that they can survive this bear market if the price goes sideways or lower for a while?
Yeah, right now I'm only recommending 5 natural gas. First of all, let me say that natural gas has a very bearish short-term situation, and it's really been caused by the big drop in liquefied natural gas, LNG exports. We were exporting about 9 billion cubic feet a day, and we're now under 5 billion cubic feet a day. So that dropped off. And then also industrial demand. People think of natural gas for home space heating or electricity generation, but the number one demand for natural gas is industrial users that are using it for power at their own facilities or for feedstock that they make. You know, petrochemical plants and stuff use it for feedstock to make plastics and a lot of other things that we use and we all take for granted. And that has dropped off significantly. So assuming that we get back to some kind of normalcy in the economy, we expect that to be coming back. We're already seeing signs that LNG exports will pick up. And, you know, it picks up in the winter anyway because the Asian nations just need it badly. So that should return. And the long-term outlook for natural gas prices, I pointed out in my Saturday presentation, I've never seen the future strip this wide between August and January. When I did Saturdays, the August futures contract, so this would be delivery of gas in August, and we have a big surplus in the summer, it was at $1.82, and that's down, you quoted today, like $1.70 or something. We have too much gas for August, so if you were taking that gas, you just have to put it in storage and pay storage fees. Well, then when we get to mid-November, December, they'll be drawing gas from storage for space heating. And the January contract is trading for like $2.80. And I can tell you, the natural gas producers that I follow, they will think they won the lottery if gas actually gets back up in the 280s. They'll be doing quite well. But let me just give you a few names that I really like. And the reason I like them, these guys have almost all of their production hedged at mid 250 range around there. I like the largest natural gas producer in the United States is EQT Corp. They're primarily at Marcellus, Utica, that's Pennsylvania and Ohio gas. They're not in the Permian Basin. They've got a lot of their gas hedged at 250. They're a very large company. That's a good one. Range Resources, that stock's like $6 or $7 now, and they are in the same situation. They're almost a pure Marcellus. In fact, they have the largest acreage position in the Marcellus Shale. And then a small one that I like because it's kind of a unique situation is Comstock. Comstock Resources is controlled by Jerry Jones. He's the guy that owns the Dallas Cowboys. He took control of that company when he merged his family partnership into it. And I believe he owns like 75% of the stock, and he backs that company. And they've got some outstanding acreage in the Haynesville Shale. And the Haynesville Shale gets top prices. It's close to the Henry Hub, where gas is priced daily. And it's down in Louisiana, and they have direct access to all the huge pipelines that go up into the East Coast and also to the export facilities along the Gulf Coast. So that's a small one that I think you guys should look at. And I think if gas gets to 250 this coming winter, That's a good, that one should double for you. Yeah, and some of these guys they produce a lot of oil, but they also produce a lot of gas. Cimarex looks really good. EOG produces a lot of gas, so if the gas price goes up too, that's really going to help them also.
Do you cover Devon Energy?
I used to cover Devon Energy. They had a lot of debt problems. They have sold off a lot of assets. It's actually on my to-do list to roll back and look. I haven't taken a hard look at it in 2 years, but it's a very solid company, and they also have a lot of gas.
Historically, Devon has a long history of solid margins. The oil and natural gas business, things go up and down with the price, but when they've had higher oil and natural gas prices, they've had good margins.
Yeah, they had a lot of properties up in Canada in heavy oil and stuff like that got killed. So, but they've sold off some properties and they're in really good shape. In fact, they spun off their entire midstream operation. They spun that off, and I think got like $3 billion in cash for it.
Do you think that the bankruptcy of Chesapeake Energy is good for the oil and natural gas price long term, though?
Well, that's going to take some gas off the market because they're, in bankruptcy, they don't let you do too much while you're in Chapter 11. I will tell you that every time I ever took a hard look at Chesapeake, I never could understand that company. I never could recommend it to anybody. So it doesn't surprise me that they went bankrupt. They would get into an area and it would become immediately, they would let everybody know that they're looking for, and all the acreage costs would go through the roof. and they ran up, the Haynesville was a perfect example. They ran up leasehold costs, and they're quadrupled it when they sent their landmen in there, and it hurt them more than anybody else. I never could understand how that company did that.
I've read books and articles about Aubrey McClendon, and he was an amazing salesperson, but the company was incredibly wasteful. And you named some examples, but he was running an oil and energy hedge fund too. I mean, he was just doing so many different things, and they were wasting way too much money on a lot of different things.
Yeah. I never could understand it, so I agree with you.
As we wrap up here, can you please talk about your Sweet 16, what it does, how you cover all these different companies, the updates that you issue, and then about your YouTube channel?
Yeah, for your listeners, and we are a subscriber service, and our subscribers are looking for independent research on publicly traded upstream and midstream companies. And so we have 3 model portfolios. I call it the Sweet 16 just because we set it up in the middle of the basketball season one year, and it just so happened I picked 16 companies, so we call it 16. But that's our mid to large cap upstream, and it's up about 50% since April the 10th. It was down a lot, but it's still trading at about a 75-80% discount to my valuations. And then our small cap, these are kind of up and coming companies, growth companies, and some of them got a lot of upside, and I've got 8 or 10 on that list. And then we have now about 2 years ago, I set up a high yield income portfolio. And right now the dividend yield on that combined group, and it's 12 companies, if you combine them all together, is generating about a 10 to 12% dividend yield. And a lot of, about half of them are C Corps, half of them are MLPs. And, there's a lot of good dividends paying companies out there right now. So if anybody is interested in subscribing to our service, just send an email to energyprospectus@gmail.com. And if they it'll be Sabrina, she handles our member services. If they tell her that they heard about us on your show, we'll give them $100 off their first year. And it's regularly $350 a year to be a subscriber. And then, so I do a monthly newsletter where we update all of the profiles, but we also send out individual company reports on about 50 companies per quarter. So the ones that are in our model portfolios, we update those every quarter. And I also have forecast evaluation and forecast models on our website you can download into Excel. And then you can just change the assumptions. So you say, okay, I want to see what this company does at $40 oil. I want to see what this company will do at $50 oil. And you can change the commodity price assumptions at the bottom, and the spreadsheets automatically update. And we have a lot of our members that they love that feature because it's then they can do their own due diligence on a company that way. Now, I don't handle anybody's money. We don't have a fund or anything like that. So they are just using the information and my knowledge of 30 or 40 years in the industry is a big help to that. And then also we have a chat room, and if they have questions, they can ask us on the chat room. And probably half our members have got many decades of industry experience, and they love to share their information. So it's really the power of our network that makes membership the most valuable.
And you also have in-person luncheons in the Houston area and Dallas area, right?
Before
the pandemic. Before the pandemic.
Actually, we're going to start having at least one, if not two, webinars per month that are going to be hosted by the companies we follow. I actually set up one for the last week of July today, and we're going to get the CEOs of the companies on there. They will present an update on their company, and then we will open it up for questions from the participants who are BR, subscribers. And then we're going to record those, and we'll send it to our worldwide membership, which is we have over 200 global members. We have members in Europe and Asia, and they love getting this stuff. One
thing for listeners, though, you don't cover Royal Dutch Shell, ExxonMobil, Chevron, and BP, though. So that's I'm sure you're going to get emails, you're going to get questions asking questions about Royal Dutch Shell, questions about Chevron, questions about ExxonMobil. So just...
For your listeners, those companies are so covered. You don't need me to tell you. There'll be 18 brokerage firms that'll give you their reports on those companies. I'm looking for the diamonds in the rough that the other people aren't going to find. Now, a lot of these companies, like we mentioned, EOG and Concho today, and Diamondback, they have a dozen Wall Street firms covering them. And I look at the other people's reports too and compare them to see what I'm, making. But a lot of these companies are trading. They're way down near the bottom of their 52-week range. And think about this: if oil gets back to 60, these guys should at least go up to the top of their 52-week range, because that's where they were valued then. And they still own all these assets, and they still got the production and a lot of running room. A lot of these guys got a lot of acreage.
Yeah, I think if there's another correction or crash in the oil price and the oil stocks do drop, I think there could be another really big buying opportunity.
Yeah, when this all started back in April, I was getting, all these companies are going to go bankrupt. Have you noticed? Not that many have gone bankrupt. And it's because they've got solid cash flow. The one thing with these upstream companies, they can hunker down and they can shut down their rigs and stuff. And we got a lot of good experienced management teams out here. And a lot of these guys are going to survive 2020, and they're going to be in great position to thrive in 2021. And I said that 3 or 4 months ago in my newsletter. I said, my goal is to find companies that pass the test of survive 2020 so we can thrive in 2021. And that's what I'm looking for in all these. So I look real hard at their balance sheets. I look at their banking relationships and just their cash flow from operations. Can they keep paying their bills for the next 6 or 8 months? And a lot of these guys have really good hedging departments too. They've hedged quite a bit of their production. I looked at one today, Earthstone Energy. I updated. They just put out a press release today with their second quarter production. And so I updated my forecast model, and they've got over 100% of their oil, over 100% is sold at $53 a barrel. So they've got their cash flows locked in. No matter what the oil price does, they've got it locked in for the rest of the year.
And that's probably a good thing, because there's not as much capital available as there was in the past for shale oil companies. Wall Street's not going out and doing a bunch of capital raises. The pension funds are not writing big checks.
And you got very nervous bankers, because these are asset-based loans, and when the value of those assets is written down, they got problems. So.
Great. Well, I really enjoyed our conversation today, Dan. I think my listeners are going to get a lot out of it, and there's $100 off if they want to take a look at. So there's some benefits here to listening to the podcast. So thank you very much for your time, and I will put a link to your website in the information and description section of the video.
Okay, thanks. And they can just Google my name and they can find it. It's Energy Prospectus, and it's just energyprospectus.com is our website.